Hey gang, in our previous videos, we made a brief introduction of how to properly account for uncollectibles with the allowance method and the direct write-off method. In this video, we're going to dive deep into the direct write-off method with a perfect illustrative example of how to successfully apply it. But first, bags. So if you've been watching the previous videos, you already understand that the major difference between the allowance method and the direct write-off method occurs based on when the company actually records the bad debt expense. Under the allowance method, the company makes an estimate in the period in which the actual revenues were earned on account. In contrast, the direct write-off method waits periods later as trying to make failed attempts of collecting on the account and then directly writes off accounts receivable. With the direct write-off method, since there's no estimate, there are only actually two fundamental journal entries that you must understand. Journal entry number 1, the write-off. So, once the company finally realizes that the account will not be collected, the write-off will actually occur. And as mentioned, it could be periods away from the actual recording of the revenue when sold on account. The write-off, since it's directly affecting accounts receivable, will simply record the bad debt expense in that period, as well as remove accounts receivable off the books. So with that being said, when writing off under the direct write-off method, you simply debit the bad debt expense and credit accounts receivable. Journal entry number 2. We know life, gang, and we understand Murphy's Law. Whatever happens will happen. And sometimes for companies, after they've written off an account, the customers finally decide to pay.
Pay me my money.
Well, I'm sure my people will be
In cash.
In terms of recording a collection on an account previously written off under the direct write-off method, you simply reverse the original write-off method, then record it as a normal collection on an account. Which means we're going to have two transactions simultaneously. Transaction number 1 will reverse the original write-off by debiting accounts receivable and crediting bad debt expense. Transaction number 2 will record the normal collection of account by simply debiting cash and crediting accounts receivable. And that pretty much summarizes the direct write-off method. So without any further ado, I think it's time for us to take a look at an example.